Hello, this is Kopi Time, podcast series on markets and economies from DBS Group Research. I'm Taimur Beg, Chief Economist, welcoming you to our 150th episode. Today, we're excited to have with us Piyush Gupta. He was with us 100 episodes ago, and now he is with us again during his last week as CEO of DBS, and what a 15-year run it has been. Piyush Gupta, welcome back to Kopi Time.
Well, happy to join you again. As you can see, I'm a little differently dressed this time, Taimur. That's because I have 5 more days of DBS life left.
Like I said, what a run it has been, Piyush. Great to have you, and I look forward to having you in the future as well, which will be my parting word to you later on as well. Piyush, I'd like to break our conversation into 2 parts. First, to take stock of how banks have done since the GFC, 08-09 financial crisis and the aftermath of that, and then to get a sense of your thinking about where banks are going. So let's start by looking back. Major global banks today are definitely more capitalized than they were 15 years ago, and they're definitely much more digital. How else are they different?
Well, I think the consequence of the GFC, the most profound impact was the huge increase in capital across the system. I think they also changed in the liquidity rules. So I think it's safe to say the banking system specifically is a little bit more safe than it used to be 15 years ago. But I think so I want to say that while that's good, I think there were a lot of attendant challenges that came along with the transition to safety. The first is I think we took enormously long to build these safety pillars. And frankly, even today, 15 years later, the work is not done. Right. Because the regulators keep tweaking. They call it different names. Some people call it Basel 3.5, some call it Basel 4, some call it the Basel Endgame, some call it the Swiss finish. But in every jurisdiction, regulators are still going back and revisiting what they did. In some cases, trying to lighten the rules, some cases trying to add to the rules. And it just seems to me that 15 years is a long time to try and get to where you need to. So I think we took too long, and that passage of time created a degree of uncertainty in the system. Right? The second thing is we didn't solve for everything. Liquidity in particular created some consequential challenges as well. Holdings of treasuries, for example, the banks started running shy of doing some of that. So they started creating these whipsaw effects in the treasury markets. We saw through the US regional bank crisis that many of the smaller banks did not actually embrace some of the liquidity rules completely. So not only did we take a long time getting to where we are, it wasn't completely consummate as well. We left some gaps in the process. I think we could have done better as an industry. I'm reminded of the Asian financial crisis. So post-98, the Asian regulators and the Asian system also responded to the crisis in pretty much the same way. They added up capital requirements, they rethought some of the liquidity requirements, they became a lot more intrusive in their supervision. But they did it in a few years, they did it with a lot less song, dance and drama. And by and large, the Asian banks have proven over the subsequent 20 years that they became relatively strong in that period of time. So now, when I say that this is a challenge, what is the implication of that been? And that has bearing on how our banks different. The implication of that has been that the banks in general have won a battle, which is around capital liquidity and solving for the old crisis. But I do think the banking system has not done as well as it could have in terms of the war, which is thinking about the shape and nature of banking in the future. Today, most banks have embraced digital, but the reality is that as late as 2016-17, I used to reflect on the fact that there were only a couple of banks in the world who were as focused as DBS was on the digitization agenda. In fact, when I talked about it at many global forums, it was so interesting that banks were still bothered about Basel. Nobody was talking technology and digital. So banks are not as advanced on the digital agenda as they should have been. A lot of banks have great apps, but if you look at the underlying architecture of technology, have banks shifted to microservices, API-based, cloud-native technology, very few have even now. And that says something, that banks are still not as far advanced as they should be. In some ways, I was actually quite surprised in the last few months. The one country which has really made huge leaps in that regard is China.
Right.
We realized that through the COVID period, when nobody was watching, the Chinese leapfrogged in terms of their transition to the new technology architecture. And I find today that some of them have made even more progress than DBS has. But when we compare ourselves with many of the Western banks, I think we're still 5-7 years ahead. So, long way to say, safer banks, but might not have made as much progress on technology and digitization as you would have expected them to or would have liked them to.
Right. Piyush, on that point that you referenced, the 97-98 crisis, it was a cataclysmic crisis. There was a lot of political dislocation and there was a lot of scarring. It took many countries years to come out of the crisis. But the banks were not considered villains in that crisis. In the 08-09 crisis, the banks were considered villains. I recall reading articles about that, there should be so much regulatory oversight on banks that their profitability should be minimal, they should be turned into utilities. But looking at the bank's performance, say, the last half a decade, they've done very well with the interest rate cycle and so on. So that portrayal of banks being the villain, being the problem, not the solution around 08-09, was that overstated? I
think it was. So I think partly, it was self-inflicted damage. So you've got to figure two things that I think the industry did wrong, in particularly the 80s and 90s, the build-up to 2000. One was compensation became egregious. And it started attracting a lot of attention when traders, investment bankers, individuals were getting paid 10, 20, 30, $40 million. That attracts a lot of attention and calls the basic question into account. I mean, are you really worth it? So that was one thing of our own making. And if you look at the industry, this big step up in compensation only happened in the 90s and 2000s. Right. So it was a focused period of time. The second thing we did wrong is we lost sight of the purpose of a bank, which is the fundamental of doing real things for real people. So to an extent, some of our product selection and some of the things that the industry was doing started looking like it was self-serving as opposed to actually having a hand in furthering the interests of the real economy or individual citizens. So I think some of it was, coming as a consequence. You contrast with Asia, and even though the Asian banks got hammered in 98, by that Asia has worked as Asia Inc. The banks play a more constructive role along with the rest of society. And therefore, you never saw the same degree of angst about banks and banking. So, I mean, the point is true. The reason why there was so much political outrage and therefore so much regulatory overhead was because of that. People thought that the banks and bankers were the villains of the piece. In some ways, even now, 15 years on, there are pockets of the universe where this has not disappeared. There's some places where it has, but in some places, you can still see this on the underlying nature of the dialogue and the nature of regulation. So it hasn't entirely gone.
Right. Now, Piyush, the other thing that I would have expected over the last 15 years with better analytics and better credit research, that banks would be expanding their sort of volume of creditors or borrowers, and that we will see the unbanked, whether it is in the corporate space, SME space, or the retail space, would be captured by banks because they have better data and better knowledge. But it seems like that space has been ceded to non-bank finance companies. So what's your sense of the banking the unbanked dynamic over the last 15 years?
Well, first of all, when I said the banks have not done as much on technology and digital, I have to add they have not done as much on data and AI either. I mean, they have, don't get me wrong, banks are fundamentally different, but they've not done as much as they could and should have. I remember banks had a head start. In the 80s and 90s, the biggest users of data were the banks in the credit card systems. And so by 2010, 20, to figure that banks don't have the right data, don't have the right data lakes, don't have the right data protocols, that's telling. But so part of the answer is in that the banks just did not do as much as they could have. But the second part of the answer is I don't think it's across the board. It depends on the region of the world. I will tell you that in India, the largest outreach to the unbanked has been State Bank of India. The Prime Minister's Jan Dhan Yojana with 300 million new accounts is all State Bank of India, and they do it all digitally on a mobile phone, and the unsecured lending on YONO is all on a mobile phone. In Indonesia, the largest amount of unbanked outreach growth is BRI, and they still continue to be the largest footfall and footprint, and they're adding customers at scale. In China, the policy banks, including Agriculture Bank of China, etc., are still doing a lot of this. So in many countries, the state, the banking, the traditional banking sector is indeed leaning in. Now, to the extent that they're not doing as much, or they haven't done new stuff like Alibaba did or some of the new fintechs did, that links back to my first comment. Some of the fintechs were more advanced about use of data and about use of ecosystems, where they were able to garner some of that data. My view is in the future, it doesn't matter whether you're a traditional bank or you're a fintech. It really matters how much progress you've made in terms of thinking about data and analytics, how you've rethought your credit underwriting process, how you rethought your portfolio management process. And then you could be an e-commerce company, a telco, or a fintech, or a bank. If you've cracked that puzzle and you know how to be where the customers are, you will win many of these games.
Sure. But Piyush, putting aside the data issue, just from a risk management perspective, despite all these Basel's various iterations and so on, we still have a regional banking crisis, which seems like a very one-on-one type crisis, duration risk and this bank get caught. Does that mean that we haven't really made that much progress on risk management? Well,
first of all, the banks which went through the regional crisis were not subject to the Basel rules. So you've got to understand that because the Fed gave them a pass, they weren't doing all the things the big banks were. So I do believe that all the banks which have gone through the Basel regime are fundamentally safer and better managed than in the past, and you see less of that. But the technical question, will there still be risks in banks? Of course there will. The nature of banking is that you intermediate time and you intermediate risk. And I don't think that's going to change. Would you believe that only banks have that risk? The other fintechs and other people who are intermediating finance will never have risk? I refuse to believe that either. So if you look at the history of the last 5 years, you could argue that the regional banks or Credit Suisse was one set of the problems. But I could equally name to you half a dozen new fintech companies, token companies, tech companies, et cetera, who also had different kinds of problems. So the challenge is quite fundamentally this, that when you have providers of capital, users of capital, somebody sitting in the middle, intermediating risk and time, no matter how smart you are and no matter how forward-looking you are, you will wind up from time to time stubbing your toes. To me, the analogy is, any country, even though you say you have a great police force and you have a great legal system and judiciary, you name me one country which doesn't have crime. This is like trying to argue that if you do your job really well, there should be no crime in a country, and that can never be.
Sure. I'm sort of conscious of the whole duration risk question, even in 2025, 2026, with all the noise around the US. But we'll keep it to the past and the future as opposed to the conjunctural, because I want good shelf life out of this podcast. But one question on the dialogue between regulators and banks. Do they listen? And is it a two-way communication?
Again, there's no one-size-fits-all answer, it's a function of where you are. Taking a third stab at the same thing, I think in the West, the US as well, but certainly all over Europe, UK, etc., the dialogue between the banking system and the regulators was more broken for an extended period of time. There was a going-in belief that banks needed to be carefully and closely managed, and there's a high degree of suspicion about banks' motivations and capabilities both. I never saw that in Asia. Right from the 2009 when I first took on my job, by and large, Asian regulators have been constructive in dialogue. They've been forward-looking. They've tried to keep a developmental hat along with their regulatory hat. And even within Asia, obviously, it changes a little bit in degree depending on which country you're in. But broadly speaking, you've not had the same degree of antagonistic engagement as you've had in several countries in the West. Now, even in the West, I think the dialogue is beginning to change a little bit in the last few years. As more and more regulators are beginning to see the world is progressing in a direction of a tokenized economy, new ways of making payments, etc., they realize they have to engage the private sector more constructively. And so it's beginning to happen. But again, I said that it's not entirely changed yet.
Are you surprised, or you think it's par for the course, the kind of credit losses we have seen on the portfolio of banks from exposure to China? I mean, China has slowed quite dramatically in the past half a decade. Would you have expected even bigger repercussion, or you think what has happened is pretty par for the course?
Well, given first I got to figure two things about China. One is China slowed, but is still growing at 4-5%. Right? You've not seen a steep recession. You've not seen a complete falling off the cliff. So most countries in the world at 4-5% growth rates, you see some pain, but it's not a huge amount of pain. So you got to start with that. China is in a relative sense slower, but in an absolute sense is still growing decently. The second thing about the China situation is that a large part of the credit in the system is still benefited by some form of state support. And therefore, whereas in the US system, by and large, all the rocks show up as soon as the tide starts receding. In the China system, all the rocks don't show up immediately. So it could well be that some things are termed out 10, 15, 20 years. In any other environment, you would call them credit losses. But in more supportive environments, you can just term out credit. So maybe there's some of that going on as well. However, even if you account for all that, the fact is that the total credit losses in China have been lower than one would expect. Even if you take the real estate sector, where you should expect to see the biggest damage, there's been some, but not so much in the bank books. There's been some in the bank books. A lot of it is in the financial markets, the bond space, bondholders, etc. So this speaks to the fact that the banking system has changed a bit. So banks are holding less of the risky assets. The financial markets are holding more of the risky assets. And so there's been a fundamental shift in the nature of the banking system as well. I should have mentioned that when you asked about how have banks changed. See, in truth, I sometimes reflect that it's not that financial sector risk has disappeared. But the risk in the formal regulated banking sector is lower because it's been squeezed out. And so some of the risk is just shifted out. Why is private credit such a big market today? Right? It's a big market because banks are refusing to put on that kind of credit. 30 years ago, banks would have been doing structuring and putting on the credit. Today, the banks don't. Project finance. So large nature, the financing has become prohibitive for banks to do. And they get squeezed out to the non-bank world. Right? And therefore, when the losses are seen also, it's also proportionate. You see less of it in the banking sector and perhaps more of it in the non-bank world.
Let me expand on that issue, Piyush, because I'm really curious about that. So what's your sense? Are we pushing risk to the private side, which is by definition a little more opaque than the banking system balance sheet? And is that something that you're uncomfortable with?
Well, I do think there's no question. Of course, we push risk out to the private side. If you look at the relative size of the private markets, both private equity and private debt, today,
extraordinary.
It's extraordinary. So you look at the total intermediate capital and see how much have moved from public markets and the formal regulated banking sector to the other side. It's huge. And which can only mean that there's more activity, action, and nature of risk happening over there as well. Am I uncomfortable with it? See, the argument that some would make, Mark Rowan at Apollo makes it very compellingly, that people who fund those private side sectors do it with the eyes open. And therefore, there's better duration match. People come in recognizing that they're going to be in there for 6, 7, 8 years. So when private credit, private equity puts money for 6, 7, 8 years, it is match funded. Right? Whereas in the regulated sector, the household savers come in with short-term expectations. They put money into savings accounts and therefore need to withdraw money in a hurry. And therefore, when the bank takes on the same nature of risk, 6, 7, 8 years, risk is putting on duration gap. I think I have some sympathy for that argument. That when people are going into a fund with the eyes open, saying it's a 6-year fund or a 7-year fund or 7 plus 1 plus 1, by nature, you've shifted the risk to the investor depositor. Now, having said that, I think that on paper, the investors deem to understand that risk. In reality, I've found that most investors, when things get bad, turn around and say we don't know. And they wind up standing in front of the same doors, whether it's the regulator or the politician or the bank, saying, hey, we did not know, we were misled, and we need somebody to make us good.
Right.
So this happened with Lehman mini bonds in the '09 crisis. It happened to a large extent in China with the P2P lending crisis. So I've seen this repeatedly, that people think that the risk is better understood, but actually it's never better understood. And therefore, by squeezing the risk out and leaving it there, I do think that there's a fair amount of residual risk, which is not adequately thought through or accounted for.
Right. So I find it interesting that we always worry about, depositor funds and the need to insure depositor funds. That has systemic implications, but a large asset price decline also has systemic implications. But somehow we don't worry that much about, controlling that risk, but we always worry about the deposit side of the business.
Well, that's my point. I mean, the assumption is that the large asset pools are held by rich people who know what they're doing.
Right.
So caveat emptor, buyer beware. In reality, it doesn't always work that way.
Well, they're the ones with, I guess, bigger purse strings to actually lobby even more so than the average depositor.
Yep.
Piyush, let's look forward. Already this has been at play for more than a decade, but it'll be a big issue going forward. Traditional banks versus pure play digital banks. What are your thoughts?
So I alluded to this just now, Timur. I think that's artificial bifurcation. I think the real bifurcation is with, providers who get digital and get data and those who don't. And those could be anybody. It could be a traditional bank, it could be an e-commerce company, or it could be a pure play digital bank part of a system. I like to believe that DBS has done fairly well. We've been able to digitize, we use data well. 18% ROE doesn't come from nowhere. So a lot of it comes. I think we hold our own against any pure play digital bank today. But it's not across the board. So I think the thing to look for is those people who can embrace digital and those who can't. One of the advantages that traditional banks have is obviously an installed customer base and a lot of inertia in our industry. The switch away from our industry, market share moves, are glacial. And they take a long period of time, much longer than brick and mortar e-commerce versus e-commerce. And I think that's a lot to do with people's attitude to money and the sense of security that they need, which comes from a physical brick and mortar presence that they can see. So even though the banking sector started getting unbundled and digital started happening about 2010, so it's been 15 years, if you look at the market shares of any neobanks anywhere in the world, they're less than 1%, 1-2%, right? So after 15 years, you hardly see market share shifts, including in countries where you say the traditional banks have lost it, they're not doing very much. You look at the UK, with some of the first neobanks were there, like Starling, Monzo, Atom. And then you could argue that a lot of the high street banks were on the back foot.
Right.
But you fast forward 10, 15 years, the high street banks are still the high street banks. So the old banks have benefited by an installed customer base and tremendous degree of inertia in the system. New banks, interestingly, the big advantage is obviously a low cost structure, right? You can focus on what you want to do. But by now, the disadvantage because they tend to be relatively narrow in the product offering. The very few neobanks which are full purpose, large scale full purpose, most tend to be either in the wealth space or in the lending space or in a microcosm of the system. And that's one of the reasons why they find it hard to get incremental share very quickly. People like to be able to go to a full service offering. The other thing I found that neobanks, traditionally my view was that the cost of customer acquisition would be much lower because they acquire customers digitally. In reality, I found that there's not that much difference between a traditional acquisition model, maybe a couple of percentage points. But after you wind up building your technology systems, your marketing systems, and start paying Facebook, Google, or YouTube for the marketing dollar, and then you multiply it by the click-through rate, it's not that advantageous. There is some, but not huge. So the best performing neobanks to me are the ones who have the capacity to leverage some other ecosystem. Because if you already have hundreds of millions of customers coming to you through another ecosystem, then the marginal cost of converting that customer to a banking relationship is lower. That's for sure. But there are not that many companies which have a large and robust ecosystem which they can then market banking services on the back of, right? So, long way to answer your question. I think neobanks do have some advantages, but I think the advantages are often overstated. And I think as long as the traditional banks are able to embrace both digital technology and data in a meaningful way, by and large, I think they will hold their own.
Let me hold into a subset of that discussion, which is the wealth angle. You just touched upon it briefly. Even in Singapore, we now have these startups which offer pretty impressive breadth of wealth offerings aimed at not necessarily the ultra high net worth individual, but definitely, let's say less than $10 million wealth customers and so on. Is that a big threat to a bank like DBS?
See, look at all of the operators in Singapore. They all have $1 or $2 billion in AUM, right? DBS has $400 billion in AUM. Every year, our AUMs are increasing by $50 billion. The AUMs are increasing by $1 billion, if you're lucky, $500 million. And so that speaks to the fact that if you have scale, if you have credible offerings, the trust element counts for a lot. The fact that you have presence counts for a lot. If you look at the biggest growth in the wealth industry in the last 10 years, across the board, not just the higher ed, but into this thing, is the traditional banks which have mopped up most of it. So yes, the Endowus and Stashaway, etc., they're credible, they have good offerings, but the ability to scale is still limited.
Okay. I'll keep that in mind. I sometimes look at some of these shiny new apps that they offer. Pretty impressive UI, UX.
They're good. Don't get me wrong, Tim. I'm not saying they're bad. They're good apps. They're credible. All I'm saying is that, if you had to bet to me 10 years from now, will one of them be bigger than DBS? I think that's a hard call.
Yeah.
Because there's just too much inertia in our system. If the traditional banks do nothing at all, right, and so you're still in a 1980s banking world, then yes, I think the market share shifts will be faster. But most banks are doing enough, certainly in Singapore, most banks are doing enough to be able to hold their own.
Right, I guess that's the key. Let me to switch the topic to digital assets. There's a lot going on the token side, the crypto asset side, and then all these CBDC as well. So, your thought on that, and one specific question in that regard is the future of stable coins, and is that a threat to bank deposits? So, both of those issues.
So, as a general rule, I think you will see more tokenization of assets. My view has always been that value of money tends to follow technology. We started off with cowrie shells, then we moved to metal, gold and silver. Then after the printing press, we moved to bills and then currency notes. And then in the 20th century, when plastic became good, we moved to credit cards and plastic. So it's just logical to assume that as the world moves, people will look for new forms of value and changing value. And already in the last 10 years, certainly in our part of the world, everybody pays on a mobile phone and everybody pays by QR code, right? And so obviously you've seen that evolution. I think there are 2 or 3 other reasons why a tokenized world, where tokenized assets or tokenized money will be prevalent. One is that the minute you tokenize, you can fractionalize. Mm-hmm. So you can go down to 0.0001 of anything, which means you can distribute more widely. A lot more people can participate. So fractionalization is quite important. The second thing with the tokenization is that you can program. So today, if I give you some money, $10, I give you the money. But in a tokenized value, this thing, I can program saying you will get this $10 provided 1, 2, 3, 4, 5, 6 things happen. So today, conditionality moves separately from value.
Right.
You can actually layer in conditionality into value. That has immense potential and power, right? When you can layer conditionality into value, then you're not looking at 2 streams, an information stream and a value stream. You marry the information stream and the value stream, and then you put conditionality on top of that. A third thing tokenization does, it lets you do atomic settlement. In real time, 24/7 atomic settlement. Whether it's PVP, DVP, an exchange trade versus a foreign currency trade, it can all be done in real time. So there's a lot of value that technology brings that can take out inefficiency in the current clearing settlement system processes. So my general view is that tokenized money and tokenized value, in fact, tokenized every kind of asset form will happen. It'll happen over time. Now, that's different from money in the sense of will it replace fiat currency, right? So I do think it's the tokens, but I do think that eventually, certainly in our construct for the next few years, money will still be fiat in the sense it will be state-backed. I think private money, and the world has experimented with private money in the past. In fact, in the 19th century, there's a lot of issues of private money. It has all of the weaknesses that we've seen historically with private money. That's compounded by the fact that today, the Westphalian system, the nation state, means that if you're running a government, you want to control monetary supply, you want to control monetary policy. Why would you abdicate your control of the monetary system to some private player, right? So one, there are inherent weaknesses in private money. Second, nation states won't let private money succeed because it undermines their capacity to function as a government, as a nation state. So I don't think you will see private money, privately issued money. And so it could be a store of value. But as a medium of exchange and a unit of account, I don't see that happening anytime soon. But as a store of exchange, store of value, yes, of course. Today there's about $12 trillion of gold in the world. There's some $4 or $5 trillion of Bitcoin or crypto coin in the world. Already it's 40% the total value of gold. So the minute you have that stock of demand and supply, there's a market. And the minute there's a market, people will use it to store value. So I do think it will continue to be in that form. Going back to this, so if I say private money won't exist but tokenized will exist, what does that mean? That means I do think you will get tokenized money but linked to the current fiat banking system. And that by and large can happen through tokenized deposits or central bank digital currencies. I think central bank digital currencies will occur, but mostly in the wholesale space, right? Because there is a real problem to solve, which is what your multi-currencies, they have the Sing dollar, the sterling, the US dollar. We never got around to a single global currency. If you can use a central bank digital currency and an exchange process to get around this multi-currency thing, you can get all the benefits I talked about, instant settlement, move money with this thing. So I do think there's a problem to solve, and you will see that. There are several experiments going on right now. But eventually, I think you'll see some kind of wholesale CBDC with a clearing house, which will work. In the retail CBDC, I'm less certain. Because to me, the retail CBDC, if you have a very good, efficient payment system in the country, instant payment, QR code based, like our Pay Now, Pay La, you can pay at point of sale. There's not clear to me what problem the retail CBDC is really solving. And actually, it winds up creating incremental challenges. Because the minute you go to retail CBDC, then you have two choices. Does the central bank issue the retail CBDC and open up accounts for all the citizens in the country with the central bank? Now, if you do that, you undermine your current banking system. More than that, you take on the onus for credit creation. And no central bank wants to take on the onus for credit creation. So there's some challenges with the retail CBDC. You could do an intermediated retail CBDC. You don't go directly to the consumer. You go through the banking system. But then that's like a tokenized deposit, you figure. So my own view is that I think the prevalent form of tokenization will be tokenized deposits. So you have a deposit, but you tokenize it, then you get all the benefits of programmability, atomic settlement, etc., without actually bastardizing the current fiat currency system. I think that's where you get to. You asked specifically about stable coins. The thing with stable coins is that they actually don't function to serve anything that a tokenized deposit doesn't. Except one thing, they can be privately issued outside of the regulated banking system. So somebody, Tether, Coinbase, etc., can say, okay, I'm creating a reserve against a bunch of assets. I'm going to issue a stable coin against it. Now that flies in the face of my first thing. Why would nation states let you do that easily? And therefore, if you look at BIS published a paper recently, I remember, comparing a tokenized deposit and a stable coin. And obviously, they argued that the tokenized deposit is a much better way to approach all the benefits we want, as opposed to stable coin, which is privately issued. Also, the fact that stable coins, some of the stable coins, as you saw, which were linked not to a reserve, but linked to an algorithmic balancing, ran into trouble. So that obviously took some of the sheen of the algorithmic rebalanced stable coins. When it comes to stable coins backed by reserve, they will exist. But then you get to the question of how often do you audit the reserve? How often do you make sure the reserve exists and operated away? How do you make sure that all the other controls are there? So for my money, I would argue that as long as, again, the traditional banking system leans into tokenizing deposits and availing of the benefits of the digital asset universe, I think that will be the game to back. If the banks don't do that and they leave a big vacuum, then yes, private players will come in and try to disintermediate that inefficiency through other forms of stable coins.
Right. Your views are very much aligned with Augustin Carstens, the former general manager of BIS. I remember him writing this essay that even the Dutch East India Company, for 50, 60 years, maintained very successfully a copper-backed stable coin. But after a while, because it's privately issued, incentives get misaligned, and you want to issue a little more with a little less copper and erode the value, and then the trust collapses. Whereas if you have state backing, that theoretically, at least, not necessarily on the table.
Now, again, the caveat to all this, all states are not the same.
Sure.
Right? And so, of course, you go to argue that where you have states where the state is not doing a good job, it doesn't have the trust of the people, the currency is getting devalued, inflation sky high, of course, that creates a huge opening for an alternate provider who gives you greater trust, greater efficiency. So you could see situations of this sort. But I'm talking about in general, if you assume that you have a well-functioning government and which is supported by the people, I think it's hard to displace that.
Right. I want to ask you a supplemental question on the issue of technology making banking seamless and transaction seamless. Should there be some friction in banking? Back in the days when there was bank runs, you would give a bank holiday, let people just calm down. RTGS and 24/7 settlement, does that add to volatility, or does it actually create a greater good?
I think you're asking a more philosophical question. Should people continue progressing, or should we put friction across different parts of the value chain, right? And it's a good question. It's not a naive question. I think a large part of what we're doing with technology, we're hurtling down this path without having thought through the other, attendant and consequential challenges that you get with it. One simple example, we made payments instant. And what happens with that is that, you do something, the money leaves the bank instantly. And if 10 minutes later, 20 minutes later, you had a second thought, you had an afterthought, you suddenly figure maybe you got scammed.
There's no stop payment.
There's no stopping, it's all gone. It's like free flow. But when you look at the reverse and say, okay, so should we therefore build in so much friction to it that you don't get the efficiency and speed? People don't like that either. There's a lot of value from instant, right? So it's a hard question to answer. Where do you draw the line? What we're trying to do these days is let most transactions proceed frictionless, but use AI and data to pop up the ones which look like there might be a challenge, and then see if you can put some friction only in those. How successful we'll be with that demarcation is anybody's guess.
So related to this is the question of cybersecurity. I had Gautam Kirti on my podcast a few months ago. He scared the bejesus out of me, detailing the kinds of attacks that institutions like DBS get on a daily or minute-by-minute basis. So your sense of the whole move toward digital and seamless banking and the trade-off with cybersecurity?
Well, for the time being, I think cybersecurity is okay, right? And so as you said, we get hundreds of attacks every day. But we do, number one, our peripheral defenses are quite sound. We have multi-layers, like an onion ring of peripheral defenses. And, we've been able to keep people out. We do our pen testing regularly. We have third parties try to hack us and attack us deliberately, and people can't get in. So, and by and large, I think that's true for a lot of the financial system. I'm not sure it's equally true for all other infrastructure providers, though informed governments like Singapore have actually designated various other critical infrastructure providers and pushed them to get the same level of safety safeguards. But on top of peripheral defense, the other thing that we've done is relied a lot on building up strength within. We call it inside is the outside. You assume somebody's inside, because sooner or later we'll leave a window unguarded and somebody will get in. So how do you protect if somebody's inside? And there are techniques for that as well. Micro-segmentation is one. So if you come in, you only hit a particular segment, you can't go everywhere else. Anomaly detection is another. We use a whole bunch of algorithms and AI to detect, hey, something's happening which is not consistent with what you would expect. So you can quarantine and shut down very, very quickly. But the truth, Taimur, is, the bad guys have the same technology tools, sometimes smarter than you, and they're continuing to proceed at a rapid pace. And so you're constantly hoping that you can keep up with them, if not stay ahead of them. One of my current big nightmares is obviously quantum. And so with the amount of technology power available with quantum and the ability to crunch through everything and unravel everybody's keys instantly, that's a nightmare possibility. Our hope is that quantum will guard against quantum, right? And so we're trying to work on that as well. But it could be challenging. One of the things, as you know, in Singapore that we did over the last year or two as an industry is this whole thing called money lock, or we call it a DBS vault. So even though all your accounts, etc., are digitally available, we encourage you to take some of it and park it in a section of the account where digital does not work. So at least you have a corpus of savings which cannot be digitally impacted. I chafed at the bit when we started that, because I said this is really going backward. You create a digital capability and then you say, okay, I'm putting this aside so it cannot be digitally touched. But I began to think, to your same question is, sometimes friction necessary. I think because the changes that are happening are so acute and nobody knows where it could go, it's not illogical to say, let's produce friction in this kind, lock some money away and not make it digitally available.
My wife always says that, the jewelry that she has is immune from cyber attack. Actual theft, yes, but not cyber attack. Piyush, I've left your favorite topic for the very end. So looking ahead at banking and the potential of artificial intelligence and particularly the advent of the large language models, how do you see that changing banking?
Well, in the short term, the changes are immense, right? And you think about, by the way, it's not just banking. So you think about any white-collar jobs, Taimur. What do white-collar jobs entail? We read stuff, then we sort of synthesize them in our brains and put them together. Then we produce some output. You'll either send an email out, or you'll do a PowerPoint presentation, or you'll do a pitch book to someone. And then maybe you'll act. If you're sitting there, you'll maybe pass some transacting entries, or you've still got to send a follow-up to somebody, you have to call somebody, right? Today's Gen AI with the LLMs at the back of it, forget domain-specific LLM, broad LLM, they do all four. They read better than we read. They synthesize, they can produce your 4-page summary like this, of everything they did, synthesize it. They produce output, visual output, audio output, pitch books. And with agentic, they do your actions. They will pass your entries for you. They will send a follow-up email. They chase for whatever. So if you think about the nature of Gen AI, it does everything a white-collar person does. In banking, 70% of our jobs are of this nature. So you will find that increasingly the computer can do a lot of this more efficiently, better, and more effectively. Right? So there's one big change. The second big change we've already seen, which is the capacity to predict. Right? And so exactly as Netflix and Amazon, we predict what will the customer want to do, what can we tell the customer. To a large extent, it's very helpful because you can give the customer a much better level of experience and service, because you're not dealing with the customer as a segment of one, and you know the customer intimately. You don't, but AI knows the customer intimately and can therefore, whether it's new products or just service, do a much better job than you could before. So I think the way banking will be done will change. Efficiency will increase. The customer experience will change. The customer outcomes will change. All of this, and this will happen in front of eyes in the next 3-5 years. The big question is, do you get a step beyond that? So at a recent an offsite meeting we had the CEO of WeBank, and he started speculating about a purely AI-driven and designed bank where the customer designs the bank. You don't even need a bank, right? So you have the AI moves, and the customer can pull it together. The customer creates his own AI bank, and each customer creates 9 billion people have 9 billion banks, all created by themselves using AI tools, who can do all of the things I talked about, but for that customer, right? Can do the management. So it's the customer's agent, which is working in the world of finance directly for a customer. Now, I haven't thought enough about how this will function, but I can see the underlying philosophy. If you can get to where I'm talking about, could you take it to the next level? I think it's not impossible.
And from a risk management perspective, are we thinking sufficiently about the disruptive impact of AI, whether it is cybersecurity related or just overall trading related or bank behavior related?
I think to an extent we are. I mean, everybody is. For example, we have a whole bunch of people focusing on the tech challenges, hallucination, wrong information, AI assuming a life of its own. And we have whole committees and model reviews, etc., to do that. But in truth, I would also say that we don't know what AI can do. We frankly don't even know how the models always work.
Correct.
But more important, we don't know to what extent AI can go. Does AI get to a state where it's almost sentient and therefore it's now doing things you hadn't thought about? Not impossible. So are there risks that will come along the pike? I think there might be. And so we've got to be quite thoughtful and cautious about, how do you put things to work? One thing, you take GenAI. Over 18 months, we've used a lot of GenAI at DBS. And till this month, we basically said we won't go direct to consumer.
Right.
So we will put a man in the middle, a human in the loop, just because I'm not sure what else is going on over there. But eventually, we get a greater degree of confidence and say, okay, let's try this. Let's do a low risk. And you start building from there. We will have to do trial and error and make sure you do the low risk things and not bet the farm as you go forward. In addition to the risks in the banking system itself, there's model risk, they do model it right and so on. That even human beings can make a difference. But the bigger challenges to me are the social challenges, right? And so I talked about a new way of working. I talked about, a new nature of work. What does that mean for society? What does that mean for the workforce? What does it mean for labor markets? What does it mean for, the old equation, the capital and labor, this thing, productivity? I don't think we've thought about any of those things. When you push the argument, people say, okay, we'll all work 3 days a week and rely on UBI, Universal Basic Income. But I don't know whether people have thought through, how this works and what it means if you're just sitting and working 3 days a week. So I think there are a lot of uncertainties out there. And this has been one of my big challenges in the last couple of years as CEO. How do you calibrate and get that balance right? One part of me responds to the Chuck Prince statement, and the music's on, you got to get on the dance floor. And I think as CEO, I would have been remiss if I had not led DBS into embracing data, AI, Gen AI, new ways of working. We'd have got left behind, and we owe it to our shareholders and our customers to do well by them. But at the same time, I've been acutely conscious of all these big issues, the ethical problems, the moral problems, the humanistic problems, the risk problems. So while we've been embracing this, we've been trying to make sure that we get the balance right through our oversight committees, through one step at a time, saying, okay, we don't have to be first to market for this. We can be third to market because we just need to understand what is going on. I'm hoping we have the balance right. So far, I think we have, but we've got to continue to make sure it's a balanced approach.
Okay, since you mentioned the bank's purpose, maybe I'm going to ask you one more question. Piyush, have the banks, which seem very enthusiastic with respect to carbon pricing and helping their clients to go through the journey, have they really managed to move the needle on green transition?
Well, I think it's not a reasonable question, Tim. But I've always maintained that to put the monkey on the back of the banks, saying they will make the green transition happen, is kind of short-sighted. There's a macroeconomy and industrialized economy that we've all collectively built up over 150 years.
Very carbon intensive.
It's a carbon-intensive economy, but that is industry after industry. So the notion that the bank will sit here and say, okay, I will now change this by deciding whether I give you money or don't give you money, is a little bit short-sighted. I mean, it's unreasonable. Who's the bank to play God? If an elected government of the country says, I still continue to need fossil fuel energy for my people, because my people who elected me still need electricity, power, and the GDP is only $2,000. Who's the bank sitting outside to say, hey, you know what, I know better than you. I don't think your people deserve energy, and so I'm going to turn off the tap on this, and you figure out how to get renewable energy, right? So it's not straightforward to say the banks should do it. Now, have the banks been able to help with the process? I think they have, but the whole transition itself has been slow. So yes, the banks have. We've got $80-90 billion of sustainability-linked loans. Do those loans make a difference? At the margin, yes. I give somebody cheaper money if they're doing green stuff. It's more expensive money. And so hopefully that incents the right behavior to do more green activities, to do less brown activities, and so on. We're giving people money for transition. As you move from brown to green, we'll give you more money, we'll create more programs. So I think we are being facilitated. We're trying to make sure that we help people go from one end to other. But can we be the principal driver of the change? I don't think that's realistic.
Finally, what makes you hopeful?
Humanity. I mean, if you think about the 5,000 years of known human history, whether it's geopolitics or whether it's innovation and tech change, this is not the first time we've come to this. People say the geopolitics is unprecedented. Even in my lifetime, forget the 20th century, I can name half a dozen times when geopolitics was more fractious than it is now. And if you go back to the 19th century, I mean, people were constantly warring with each other all the time. So this has not been the worst. And if you look at the pace of change in the 1880 to 2000 period, to the 1900 period, with the advent of electricity, power, steam, transport, globalizing, world came together. I mean, the world saw some massive, massive changes at that point in time as well. So even from an innovation standpoint, while there's a lot of innovation happening now, we have seen that before. And I am heartened and hopeful about the fact that we as humanity have been ingenious enough and creative enough to see our way through these issues. And by and large, the world is in a better place today from a quality of life standpoint. If you park the environmental challenges for a minute. Healthcare conditions are better, lifespans are longer, infant mortality is lower, educations are higher, poverty is lower. By and large, the world has progressed well. If we can see our way to addressing some of the big planetary challenges, climate and biodiversity for sure, I think we are still in a good place in terms of where mankind needs to go.
Well, on that note, Piyush, thank you very much for your time and insights. I'm not going to say goodbye to you because I look forward to having you back on Kopi Time.
All right, maybe the 200th episode we'll do again.
Sounds very good. Thank you very much.
All right, take care. Take it, Amur.
Thanks to our listeners and viewers as well. Kopi Time was produced by Ken Delbridge at Spy Studios. Violet Lee and Daisy Sharma provided additional assistance. It is for information only and does not represent any trade recommendations. All 150 episodes of the podcast are available on YouTube and on all major podcast platforms, including Apple, Google, and Spotify. As for our research publications, webinars, and live streams, you can find them all by Googling DBS Research Library. Have a great day.